Hello everyone and welcome back to my channel. So what prompted this talk today is I was talking to a friend of mine and she was explaining to me about getting a loan to purchase her parents' property. And I explained to her about the loan assumption and its benefits. And then a friend at my title company called and asked me, do I know about loan assumptions? And I told her, yes, I do. Let's talk. Listen, if you're navigating this high interest rate market, whether you're buying, selling, or advertising clients, there's one financing strategy you don't want to overlook, and that's loan assumptions. Today, I'm going to break down how they work and why they're gaining traction, and what you need to know and what you need to watch out for. An assumption loan allows a buyer to take over a seller's existing mortgage, same interest rates, same terms, and remaining balance. That means if the seller locked in a 3% rate in 2021, the buyer can assume that loan instead of taking out a new one at a 6.35. This arrangement serves as an alternative to attaining a new loan, transferring financial responsibility from the original borrower to the new one. Sounds like a great idea, right? Well, let's talk about the buyer benefits. Stating the obvious here, lower interest rates mean lower monthly payments. Also, potentially skipping hefty lender fees, and in some cases, depending on the lender, it can be a faster closing timeline. Assumable loans can be only used on government-backed loans such as VA, FHA, and USDA. But this is also a great opportunity for buyers to use their government home buyer assistance program. And for sellers, this is your leverage. Marketing your home as a loan assumption can make your listing far attractive in some tough markets. And you can justify a higher asking price. And it may reduce time on the market. But sellers, to do this, get prepared. Check to make sure your loan is assumable. You will also want to find out what is the timing of the loan assumption process. What are the costs to assume the loan? Because there may be prepaid costs to create a loan assumption. So find out also if the full amount can be assumed, or does your loan need to be drawn down to be assumed, which also includes your property tax. So gathering this information before marketing your home and discussing this with your lender is essential because it's required for approval. So go ahead and do this ahead of time. But it's not all smooth sailing. Here are some caveats. Keep in mind, not all loans are assumable. Conventional loans usually aren't, but check your mortgage agreement for details. Buyers may need to bring cash to cover the equity gap. Also, approval is acquired by the lender for the borrower to meet the lender's credit and income requirements, similar to a traditional loan application. And sellers might be liable if the buyer defaults. So sellers, look into how you can be released from the loan from your lender. And to my service members, thank you for your service. Really consider your options because a veteran who sells their home with a VA loan to a non-military buyer may lose all or a portion of their VA entitlements, limiting their future use of the benefits until the loan is fully paid. So, something to consider. But assumption loans are ideal for buyers that have access to cash and sellers with low-rate government-backed loans. They can be a smart play for agents and investors looking to structure creative deals. So that's it. If you found this helpful, please hit the like and subscribe button and drop your questions below. Also, I created a checklist for assumption loan negotiation. DM me loan assumption checklist and your email address, and I will personally email you. Thank you so much for joining me today and have a blessed day.